And I see you guys filtering in little by little, so we'll give it a minute to really get started, but I wanted to introduce myself. I'm Mariela Brahimi from ACE by TSK. We're Association Community Education by TSK Marketing. Wonderful to have all of you. Looks like we are aggregating quite a lovely crowd this morning. And so this is our online series, and I'd like to just start by thanking all of our sponsors who make this series possible: A1 Appliance, Association Reserves, Hotwire, KBR, WRG, Regal Paint Center, and Plasteridge Insurance. So thanks to all of our sponsors for helping make this happen. Introduce our speaker and let him kind of take it away and conduct his presentation. So thank you, Will. Welcome.
Sure. Yeah, hey, good morning, everybody. Thank you very much. Let me share my screen here. So in just a second, you should see sort of a white background. This is Fundamentals of Reserves. I'm trusting everybody can see that now. Yes. Yeah, thank you. Great. Thank you very much. So yeah, my name is Will Simons. I'm the president of the Florida office for Association Reserves. I'll give a little bit longer intro here in a moment, but just wanted to say thanks to Jeff. Thank you to Mariel. Thank you for putting this on today. I really appreciate the opportunity. Nice to work with you guys as always. What I usually do is I kind of say hello on camera here in the beginning, but then I'll turn it off as soon as I start the actual course material, just because I don't think I'm needing to be on there, and I think it's just kind of distracting. I'd rather everybody pay attention to the slides and the actual content that we have. So today's class is called Fundamentals of Reserves. I've been teaching this for probably close to 12 years now and in various forms. Class should go for maybe about 45, 50 minutes, and then we'll have time for some Q&A at the end. Almost all the time that we do this, there's more questions than time available. So when we get to that stage, I will do my best to go through those as much as I can. But certainly if there's anything that you wanted to ask about that we don't have time for today, everybody should have my contact information there at the end or through the follow-up materials that Jeff will be sending out. So please feel free to reach out if there's something that you'd like to talk about. So yeah, feel free to use the Q&A button on your Zoom taskbar down there. That's how you'll submit the questions. So not the chat feature, but the Q&A button is how we'll take those questions from you today. It's only happened once, but I feel like I have to say this every time, just in case my office loses power or internet. I will try to get back on as soon as I can. Knock on wood that doesn't happen today, but please stay in the class and we'll try to reconnect as quick as possible. So for those CAMs that are in attendance today, this is good for 1 hour of continuing education credit. So please, if you did not register with your CAM license number, maybe email that to Jeff and he can make sure that we get everybody the hour of credit. So let me switch off the camera and then we will get started with a little bit more of an introduction. Okay, so yes, as I said, my name is Will Simons, president of the Florida office for Association Reserves. Been with our company since 2008, and I spent most of my career in Florida. We've had clients going back to the early 1990s in Florida, and nowadays we work with a couple thousand different communities all across the state. The RS after my name, that stands for Reserve Specialist, which is the signature credential that's provided to people in our field who have demonstrated their experience and expertise in preparing reserve studies. That designation comes from CAI, the Community Associations Institute. Hopefully some of you guys are familiar with CAI. Personally, I always like to point out I have lived in both condos and HOAs. I spent about 6 years as the treasurer of my own community in South Florida. I had a budget there of a little over $1 million, about 635 homes in the HOA. And the reason I always like to point that out is just that I know what it's like to be on the other side of the table, right? I know this can be a thankless job to be a board member, even to be a manager. And so I tip my cap to you guys out there who are volunteering your time, taking on all the grief and the criticism that comes from being on the board, and just trying to do what you can to make life better for your communities. So thank you again for all the hard work that you do. Our company is the oldest and largest reserve study provider in the United States. We've been in business now since 1986, and in that time, we've completed tens of thousands of reserve studies for all different types of properties all around the world. At this point, we have actually 13 offices. We recently opened a new one in the Ohio area, and we have more credentialed reserve specialists on our staff than any other company. The majority of the work that we do is for community associations, which of course includes all types of condos, HOAs, timeshares, and other types of residential properties. But we also have a great deal of experience with other property types. So office buildings, hotels, resort properties, worship facilities, schools, you name it. We've been very fortunate. For the last 9 years in a row, we've been awarded a Reader's Choice Award by the Florida Community Association Journal. So we're very grateful for that. And another thing I always like to point out here is that our only job as a company is preparing reserve studies. Okay, we are not an engineering firm, not an accounting firm, but rather a very specialized consulting firm, which I think kind of takes a blend of building sciences and accounting and finance and delivers that in a package to our clients, which helps guide them towards a successful financial future. If we do our job well, if our clients follow the plans that we help design for them, the benefit of doing that is that hopefully they can reduce the risk of special assessments and bank loans and all the other types of financial distress that can find its way into community associations. So if you'd like any additional information, I know it's kind of small print, but down there at the bottom right, reservestudy.com, that's our website. I'll have my email address up on the screen again later. That's wsimons@reservestudy.com, WSIMONS@reservestudy.com. Okay, so as Jeff, I think, mentioned, we've taught this class with TSK for a number of years. Used to do this live and nowadays on Zoom, and I've modified the class a little bit. So even if you've taken this before, there's going to be some slight differences. So hopefully that makes it a little bit new and exciting. The biggest change is that we've added in this last discussion at the end, talking about this new piece of legislation we have, Senate Bill 4D. But before we get to that point, we'll spend a little bit of time in the beginning answering this, relatively basic question, foundational question: what are reserves? And then we'll spend most of the time going through reserve studies and talking about how those studies are used by associations to make sure they are on the right track with regard to long-term planning. Yeah, so that's basically what we've got for you today. Feel free to take notes as you go along. We will be sharing the recording and all of the slides for today. So if you miss something, don't worry. There will be an opportunity to go back and see that again. But let's go ahead and kick things off here. So what are reserves? Well, if you've been in this field for a while, whether you're a manager, whether you're a board member, this is probably going to be somewhat of a review. But if you're newer to this or just want to refresh, we'll just spend a few minutes talking about the two main aspects of any given association's budget. Okay. So first, the budget can be categorized, I think, into these two parts, what we call the operating fund and then the reserve fund. But first, we'll talk about the operating fund. Okay, so operating money is essentially there for the routine costs of running the business of the community association. Okay, so these are going to be the daily, weekly, monthly expenses for things like utilities and insurance and payroll and preventive maintenance and so on. So I always like to use analogies. And my analogy here is that if you think of the operating fund kind of in personal finance terms, you can maybe compare that to, just a personal checking account for an individual, right? That's how you pay your groceries, buy your groceries, pay your car payment, and so on. Operating money is unrestricted. Okay, so that means you can spend that money on any bill that the association has to pay. Typically, the money will be spent in the same year that you collect it. Okay, so what that means is that if you've designed a very good budget, hopefully there's not any substantial surplus or deficit at the end of the year, right? You spend all of the money that you collect within a given fiscal year during that same year. Okay. Now let's contrast that to the reserve account. Now, reserves are there for the long-term expenses that associations have to pay for. And sometimes those things may not happen for 5 or 10, maybe even 25 years at a time. But when they do occur, those might be some of the biggest bills, the biggest costs the association will ever have to pay for. So reserve money is typically going to be used for things like roof replacements, painting buildings, taking care of roads and parking lots, lots of other projects that we'll talk about later on. But for now, just want to really distinguish between these two types of funds. Reserve funds are restricted. So what that means is that once you put $1 into a reserve account, it can only be spent on specific things, not on any random bill or expense the association has to pay for. That's what operating money is for. Another difference is that, again, in contrast to operating money, reserve money does accumulate, sometimes taking place over many, many years, building up an account balance until it needs to be spent for its intended purpose. So going back to that same kind of analogy, and that way the reserve account functions more like a savings account, maybe even something like a college fund or a retirement fund. It's specifically there for a particular reason. Money grows over time until that need arises. Okay, on this slide here, I've got a very short excerpt. This is from Florida Statute 718, something we call the condo statute. And what I've highlighted in red here, this is the portion of the text that talks about what associations must be reserving for. So if you look at that section, the statute requires that condos reserve for 3 things in particular, and then they have this one general kind of catch-all definition at the end. So the 3 things they name specifically here are roofs, painting, and pavement resurfacing. And then the kind of general idea at the end is, and for any other item with a replacement cost greater than $10,000. Now, if you're wondering why did they pick $10,000, as I mentioned, I've been doing this class for a long time now, and I've asked this in front of accountants, in front of attorneys, in front of managers, and I can't recall a time anybody had a clear answer as to why the number was $10,000, right, as opposed to 1,000 or 25,000. I don't think anybody really knows. I think it's back in the day, decades ago, when they wrote this statute, I think they just picked a number that sounded high, that sounded significant, and just said, all right, let's make that the threshold. The point is that $10,000 cost threshold is somewhat arbitrary, okay? And for a lot of associations, that number is probably way too high of a threshold to set, right? They may be better off including things that are less than 10,000 because they would still be financially significant to that particular association, okay? And by the way, before I move on from 718, I'm going to talk about Senate Bill 4D at the end a little bit, but the majority of this, initial part of this class, we're talking about the statute 718 kind of as it has been for a long time. There's a lot that we expect may be changing about that new bill. So for now, just kind of wanted to establish that this is not meant to be a legal review of the latest and greatest information out there. But switching over now to HOAs. This is a portion of the statute that pertains to HOAs, 720. And this one actually has even less to say about what associations should be reserving for. So again, unlike the condo statute, the HOA statute does not have any specific checklist of items that you should include. Instead, basically just says that, hey, look, there are certain things that the association is responsible for, and if you don't have reserves, that could result in a special assessment. So not very helpful. But the good news is that there is actually a much more realistic, much more thorough way to go about defining what any type of association should be including in its reserve plan, which we'll get into here in just a few minutes. For now, just want you all to keep this sort of basic definition, basic concept in mind. Okay, reserve money is there for an association to save over a long period of time for major repairs, major replacement projects. Okay. Now, take a moment and notice what I did not say. Okay, I did not say that you could spend reserve money on capital improvements, on paying a surprise insurance deductible, really any other purpose. Okay, so just as a quick example, let's say there's an association out there that does not have a playground in the community, but all of the residents get together and say, look, it would be so nice to have, we've got kids everywhere, let's put in a playground. Now that might be a very worthwhile thing to do, but they couldn't use reserve money for that. And the reason is they're adding a new element to the association And that new thing would have never been considered in any of their prior year reserve budgets. Okay, so any prior reserve contributions that had been collected, they would have never taken that new cost into account. So in reality, it might be a very good thing to do. Maybe a playground is going to add a lot of property value there, but the initial expense, the construction of that playground, would have to be paid for by some other means. Okay, it's maybe a capital fund, a savings fund, even a surplus in the operating budget one year, but not reserve money. Now, once it was done, once they had that new playground, yeah, absolutely. From that point forward, they should start reserving for future replacement cycles for the equipment, the fencing, the fall surface, and all that. It's just that initial cost, that capital improvement, that is not something they should be spending reserve money on. All right, let's switch gears for a moment. That was, like I said, pretty short, sweet review talking about what are reserve funds. Now we're going to talk about kind of the meat of this course, which is reserve studies and how these are used by properties when they prepare their annual budgets. Okay, first things first, just want to establish the definition of the term reserve study. This is something that has come up a lot just in the last few months with this new legislation, but I want to make it clear that a reserve study has been defined for close to 25 years now. This comes from National Reserve Study Standards. And basically it specifies that a reserve study is a tool, right? It's a document, but it's a tool that identifies the current status of the reserve fund. And secondly, provides a funding plan that gives guidance about how to deal with future expenditures. Okay, so again, notice what I'm not saying. A reserve study is not an insurance appraisal. It's not a turnover study. It's not an engineering report. It's not a milestone inspection. It's a very particular document that contains very specific content about both the physical, but also the financial elements of that community. Okay, there are three types of reserve studies. So if there's a property that has never had one done before, they'll begin with what's called a full reserve study. So in that type of study, the provider is literally doing everything from scratch, conducting a site inspection to take measurements, take photos, basically gathering up all of the raw data that will eventually become the component list for that property. Okay. Now, after they've had that initial full study done, there are two types of updates they can do afterwards. So the first type of update is called an update with site visit. So in those cases, you have a new site inspection taking place, but it's going to be based off of the existing list of components, right? And really the idea there is just to identify any significant changes that have taken place, either in life expectancy of those components or their cost estimates, reevaluating based on the conditions of the property, right? If a project has been done, you know, say the building has been painted since the prior reserve study took place, then the remaining life expectancy for that paint project needs to be reset. And the way you would do that is by visually inspecting it and verifying that it was done. There are some states that require these types of updates at specific intervals. Usually it's every 3 years, maybe every 5 at most is kind of the best practice. But you know, it differs. So in California, in the state of Washington, it's required every 3 years. I believe Virginia and Nevada every 5. We'll talk later on about the new structural integrity reserve study idea and what the frequency is there. But best practice is about every 3 years, right? A lot can happen in 3 years, especially in South Florida, with the amount of storms we get, the amount of deterioration that can take place in a very short amount of time. A reserve study is not a once in a lifetime thing. It's not a once in 10-year thing. It's something that needs to be updated fairly frequently. So the last type of update is what's called an update with no site visit. And that's exactly what it sounds like. Still a whole new engagement. But in these cases, instead of conducting a new visit to the property, the provider will be just corresponding with the board, with the property manager, in order to find out what projects have taken place, what new information is now available since the last time we were on site. And so these no site visit updates can be a very good tool to use in the in-between years. You know, if it's only been a year or two since somebody was on property and really no major projects have gone on, a low-cost update with no site visit might be the right thing to do at that point. Okay, there are two parts to a reserve study, what we call the physical analysis and then the financial analysis. We'll talk about each one of these. The physical analysis portion of a reserve study, this is the part where somebody's actually doing that on-site visual inspection, looking through all of the common areas, right? So the scope of a reserve study does not include areas that are individual owners' responsibility to maintain. But you kind of imagine, whether it's a condo or an HOA, what those common areas might consist of. It's going to be everything from the roof of the building, the mechanical rooms, the equipment, but also amenity areas, pools, tennis courts, gyms, lobbies, anything and everything that the association is responsible for should be considered. Doesn't necessarily mean that you always are going to be funding for everything that they have, but it's important to at least ask the questions. So this physical analysis involves taking lots of measurements, photos, documenting model and serial numbers for equipment, basically doing whatever it takes to gather up all of the raw data related to each reserve component, which we then eventually use to determine future life expectancies and replacement costs. All right. So during this portion, this physical analysis, usually very, very helpful to meet with a representative from the property. That can be a board member, it can be a finance committee chair, it can be the property manager. But the idea is to make it a collaborative process, right? Meet with the representatives of the property to gain from their insight, from their experience. We come out and do an inspection for a reserve study. We might be there for a day or two. That's not a substitute for the building engineer who's worked there for 20 years and knows the place inside and out. So sometimes we'll have clients that kind of think of this reserve study as something that they just send away for in the mail, right? And 6 weeks later they get a report. It's not supposed to be that way. It should be a collaboration between the provider, the board, the manager, anybody else who has helpful information about the property, so that we can collaborate and put our heads together and make sure that everything is as accurate and as thorough as it can be. Okay, the second part of a reserve study is that financial analysis. And this is basically everything that takes place after the inspection back at the office, where we organize all of that raw data from the inspection, and we can start to analyze things and research cost history, find out when projects took place, compare that information against experience working with other properties. The idea there is just to kind of fill in all the gaps, right? Once we have that accurate picture of the history of the property and a good idea of what they can expect going forward, now we can start to make some financial conclusions and recommendations. Okay, there are three outcomes to this process, three outcomes to a reserve study, which we'll talk about one at a time. The first of those is the component list. Okay, so the word component in this context really just means some instance where the association will be spending some money. Okay, so a reserve component might be a roof replacement, might be a swimming pool resurfacing, remodeling the lobby. But the idea is that for each component, we're going to have three important pieces of information that will be determined. The first one is the useful life of that component. And what we mean by the useful life is the overall lifespan of something. How long will it be in place, serving its value to the community from start to finish, either from when it was originally installed, when the builder put it there, or when the last time it was replaced or most recently done, until that needs to be done again, right? So the overall timeline, the overall interval between projects. The second estimate is the remaining useful life. Now that number is always determined relative to a certain point in time. So for example, let's say we've got a component that has a useful life of 10 years, but as of this fiscal year, right, going into 2023 now, let's say it's 3 years old. So in this case, we would say as of this fiscal year, its remaining useful life should be about 7 years, okay? Now, lastly, we need to come up with an estimate for replacement cost. And over the years, some folks have asked, well, does something need to be fully replaced in order to list that as a reserve component? And the answer is no. It does not always require a wholesale replacement of something to fund reserves for it, right? You could pick a different word. Maybe it's an upgrade, a remodel, a modernization, a resurfacing. Yes, in some cases, it is a wholesale replacement, right? If you have a cooling tower that needs to be replaced, you're taking the old one away and putting in a new one. That's pretty straightforward. But the idea I want to drive home here is that don't get too hung up on this notion that you have to be fully replacing something. Sometimes it's just a matter of spending significant amounts of money to preserve a component to make sure that it's still adding value to that association. Okay, so this is going to be a little bit of a lengthy overview here, but I want to talk through the methodology of how do we determine what goes into a reserve study, right? And I mentioned earlier the Florida statutes, in particular 718, and kind of the little checklist that they give you about what you should be reserving for. But I don't think that's very helpful in most cases. So I want to talk you through what we do professionally. Most professional reserve study providers use this 4-part test, which again comes to us from National Reserve Study Standards. This is not our company's opinion. It's not my opinion. These are national standards that have been in place for a long time. And the beauty of these standards is that they give this kind of open-ended definition of what a reserve component should be. The nice thing about this test is you can apply it to any different type of community. So instead of going into a project with that kind of predetermined checklist mindset, we're going to go in there with our eyes open, looking for anything at that property that might meet these criteria. So I'll talk through these kind of 4 parts one at a time. Now, the first part, I think, should be the most obvious. It has to be the association's responsibility to do that thing, right? So an example of something that might fail this part of the test, most of the time it's going to be windows and doors in a condo building, right? At least 99% of the time, the way the governing documents read is that the individual unit owner is responsible for his or her own windows and doors. So if that's the case, as it most often is, there's no need to include funding in the plan for those windows and doors. If you've got an HOA where your roads are maintained by the city or the county, right? It's not a gated community, then there's no need to include funding for road repaving. That's not the association's job to pay for that. Okay, the second part of this test is that the component has to have a limited useful life. So, in our business, in our profession, we really don't use the word forever, but if something should last indefinitely and there's no timeline when you would expect to replace it, then it really should not be considered as a reserve component, right? If you think of something like the foundation of the building, the structure of the building, right? Even the electrical conduit inside the walls. These are things that should last the life of the property, right? However long that is, right? It could be 50 years, 100 years or more, but you're not ever going to have to actively fund for replacing those. It's much more likely at that point that a developer is going to come in and knock down the property and build something new then you would actually have to replace those things. Okay, the third part of this test, I think, is maybe the most complicated, and which is that a component has to have a predictable remaining useful life in order for us to include that as a reserve component. So the key word there is predictable. And to be even more specific, what I mean is predictability in terms of scope and frequency. Okay, so if you can't reliably predict how much money you will spend on something or how often, then it's probably not the best idea to handle that through reserves. Okay, and I'll give you the classic example here. A lot of associations will ask us, can we include our insurance deductible as a reserve component, right? That's a really big number. If we get a hurricane and we have to pay our deductible, it's going to be really hard on our association. We would like to list that as a reserve component and start saving up for it. Okay. I understand why they would want to do that. It's not a bad, not the worst idea in the world, but the question from us is going to be, well, okay, let's say we did that. What would we assign as the useful life, right? In other words, how often are you going to have to pay that deductible? Which of course, nobody knows. That's why we have insurance in the first place. Those expenses come as a surprise. It's the result of a natural disaster, a fire, a flood, a hurricane. And to make an arbitrary prediction about how often that might happen is just guesswork, right? It's getting away from responsible planning, okay? Now, that's not to say that we don't recommend you have some kind of plan in place, right? It's Florida. There will always be more hurricanes over the years. Every association should consider the reality that they'll have to pay a very expensive deductible. The problem is just that from a reserve standpoint, we don't know how often that will be. And so there's really no way for us to responsibly tell a client how to fund for that, right? Normally what we do tell them is that, in addition to your operating account and your reserve account, maybe consider a third account, an emergency fund, or even an emergency line of credit that's available to the association in the event they do have to pay that deductible one day. So again, it's not that we're telling you to ignore the situation or ignore that possibility. Just don't handle that as a reserve component, because if you do, you're going to have to base some funding calculations off of a timeline of expenses. And if the reality of those expenses is that they don't fall in line with the plan, then all the calculations get thrown off, right? Let's just assume we made a guess and we said, okay, every 10 years, you should have to pay your deductible. All right, we're assuming there will be a major hurricane at once every 10 years on a nice predictable pattern. But let's say you get 3 storms in a period of 5 years, right? And now you're expecting that reserve account will fund for that deductible each and every time. Well, that's not what you had assumed before. And so now with that additional cost in the model, you're having to pull money away from the other reserve components that do have a predictable lifespan, which means you're borrowing from Peter to pay Paul. You're going to need to have some special assessments to make up for those shortfalls. So again, a common question, but we would say that insurance deductibles really fail that predictability part of this test. Now, the last criteria here, does this component represent a significant cost to the association, right? Above this minimum threshold cost. Reminder, we talked earlier about that statutory number of $10,000. But again, in our experience, I would say most of the communities we work with, they probably should be thinking a little bit lower, right? The advantage of doing that, let's say they pick $3,000 or $5,000 as their threshold. The advantage there is that, yes, they will have more components listed in their reserve schedule, but that also takes the pressure off of the operating budget, which is otherwise going to have to absorb those costs whenever they come along, right? So let's think about a very small association out there. Maybe they have 6 projects that would cost $5,000 each. Okay, technically speaking, they would be permitted to leave those out of the reserve plan because individually they cost less than $10,000. But let's just make an assumption that they have a run of bad luck and all 6 projects happen to occur around the same time. Well, if they're not funding those in reserves, but they still have to spend all that money, that's a combined total of $30,000 that they're now having to squeeze into the operating budget for those years, right? Now, most associations are managing cash flow pretty carefully. Maybe they have some bad debt, but let's just say cash flow is a little tight. They have this $30,000 quote unquote surprise. They might find themselves in a little bit of a tough situation. But if they had those listed as reserve components, then they would be able to tap into reserve money for those things and not burden the operating budget with those surprise costs, right? Hopefully that's less disruptive to the community. But the real point here is that there is no one number that is appropriate for every single association out there. It's not a one size fits all approach. So you might, if you're in a smaller community, maybe think of something like $1,000, $1,500. If we had a bunch of stuff that all came in at this price point, does that impact us in any way? Okay. So outcome number 2 is what we call this evaluation of current reserve fund strength. The shorthand way of describing this is using a metric called percent funded. So one of the best ways that I found to explain the concept of percent funded is using this analogy of a credit score. Okay, so we've all had our credit reports pulled. Hopefully what your score is, plus or minus 10 or 20 points. But you also understand that to an outside party like a bank or a credit card company, your credit score is an indicator of what kind of risk you are, right? So in the same way, if you kind of think conceptually as a reserve study, sort of like a credit report for an association, and if you had to distill that reserve study down to one result, I would say that should be percent funded, right? We measure it on a 0 to 100% scale, and we consider anything between 0 and 30% funded to be a weak position. So in that range, those associations will have a much higher likelihood of special assessments, loans, cash flow crises, that kind of thing. Once they're above 30% funded, we consider that to be kind of a fair or moderate position. Not an emergency anymore, but there's still room for improvement. Where associations really want to be is here, above 70% funded. That's where we see the lowest statistical risk of those types of problems occurring. All right, so that's the concept of percent funded. Now let's actually talk about how we calculate it. So it's a fairly simple idea. All you're going to do here is look at how much money an association has at one point in time, and then compare that amount against how much money it should have at the same point in time, right? So this number divided by that number, we express it as a percentage. That's what percent funded is. So the first part of this test, how much money do you have? That's the pretty simple part, right? When we're doing a reserve study for a client, we're going to look at their financial statements, maybe talk to their bookkeeper and say, okay, as of this upcoming fiscal year, right, January 1st, 2023, let's say, how much money is this association going to have in reserves, right? So that's the actual factual cash that they have. But in order to make sense of this, we have to know how much money they should have. Okay, now this amount, how much money they should have, that is a number, a theoretical number that we call the fully funded balance. Okay, so the way I like to put this in perspective is to frame it as a question, right? Now, if I just told you that there's an association out there that has $50,000 in reserves, but you don't know anything else about the community, is that meaningful? Have you, can you do anything with that information? Right now, we hear this kind of thing all the time from board members. Somebody might say, look, I think we're in great shape. We have, like $900,000 in reserves. And I always have to point out that that's great. I'm glad to hear you have reserve money, first of all, but we don't really know if that's adequate until we do the math, until we have something to compare it against, right? And that's where this concept of the fully funded balance kicks in. Right, so just to make it really clear, let's just say we're talking about two different properties, right? If I'm working with a little two-story building with no amenities, just a parking lot, it could be that $50,000 is plenty of money for them. But if you've got a luxury high-rise building, you'll probably understand $50,000 is a drop in the bucket. That can be wiped out in one installment of one paint project, right? So there's not a one-size-fits-all number. We have to think of things proportionally. And that's where the beauty of percent funded comes in. So let's take this one step further. How do we calculate that second number, that fully funded balance? Basically, what we're going to do here is look at the association on a component by component basis. And we are looking at how old each component is compared to its overall lifespan, right? Its useful life. That gives us a fraction, right? Age divided by useful life. We then multiply this fraction by the replacement cost for that thing, right? And we're going to repeat that process for every item on their component list. Now, the beauty of doing this is that it tells us in the present day, based on the age, how much money that association should have today for its eventual replacement, okay? Now, when we do this, it doesn't matter if the association has 4 components or 400. What we're going to do is calculate the fully funded balance for each one, then add all those numbers together, which gives us a combined fully funded balance for the entire association. Once we know that, now we go back and we can look at their balance sheet, look at how much cash they do have on hand, and compare that and put it in perspective. So we'll take a couple slides here and just run through a brief example. Let's all pretend that we're on the board of this community. We'll call the Seaview condominiums, and we're going to do a simple exercise to calculate percent funded as of the start of this fiscal year. Okay. So let's say we've done the first part, right? We looked at the balance sheet, we talked to the accountant, and we know that going into next year, they're going to have $60,000 in the bank. Okay. So that's the first part, the numerator of that fraction. The next thing we need to do is to calculate the fully funded balance for each of their components. So for the sake of this example, we're just going to look at 3 things. The first one, let's say, is the roof. And let's say the roof on the building is 10 years old with an overall useful life of 20 years. And let's say that the current cost of replacing that roof is $80,000. All right, keep in mind, I'm gonna hit this point a few times here. The fully funded balance is only the proportion of that cost that they need to have on hand today. So since the roof is halfway through its life, in theory, they should have saved half of the replacement cost at this point in time, recognizing there's another 10 years to collect the difference. So if we take 10 over 20, multiply that by the 80,000, we can determine that the fully funded balance, the FFB for this roof, is $40,000, right? Halfway through its life, we should have half of the replacement cost saved up. Okay, let's do the same sort of thing for the gym equipment. Let's say that that equipment is 5 years old, overall life expectancy of 15 years, and at a replacement cost of $30,000, the fully funded balance for this gym equipment should be $10,000. Again, a third of the way through its life, a third of the cost in the bank is the right number. I know I keep coming back to this, but this is something that trips people up quite a bit. They think fully funded means we have to have the full replacement cost in the bank, which is just not the case. Why would you need to have, let's say you've got a brand new building, it's a 2-year-old building. Why would they need to have the full replacement cost in the bank for their elevators, which are going to last 25 years, right? It's just the proportion of that cost that matters. Okay, we'll do one more. Let's say that they painted the hallways of the building 2 years ago, and they want to do that every 8 years on a cycle. That's great. Okay, cost estimate is $100,000. 2 divided by 8 times 100,000 is 25,000, right? So that fully funded balance for painting is 25. All right. So now that we have done that, right? And just you can imagine doing that for a couple dozen other items. But for now, let's just say it's those 3. We know what our starting reserve balance was. We have just calculated the individual fully funded balances for each of those components. That enables us to calculate percent funded for the entire association as a whole. So it looks like this. We take the 3 numbers we just calculated, adding them together. 40,000 for the roof, 10,000 for the gym equipment, 25 for painting, combined total of 75,000. That's how much money this association should have in the bank. Now, since they only had 60,000, 60 divided by 75 means they are 80% funded. Okay, still a strong position to be in, but maybe a little bit higher contributions going forward just to try to get closer to that center of that bullseye of 100% funded. All right, so that was our first 2 outcomes, the component list and then percent funded. The third and final thing you get from a reserve study is the funding plan. Okay, so if you think about those first 2 outcomes, right, the component list basically tells us what you're reserving for. So it's just the nuts and bolts. What do we have here? What are our needs going to be? We then looked at percent funded. That tells us where the community stands financially as of a certain point in time. And once you know those 2 things, the final question to answer is, well, where do we go from here? Okay. So one of the first things that we do when we're designing a funding plan is we will look at the current budget, right? Let's just, first of all, try not to rock the boat. What happens if they just continue doing what they're doing, right? If we look out at the future expenditures and the projected income to reserves, we can determine if that's going to be enough, right? And if it's clear that the existing plan will not be sufficient, that they will run out of money at some point, then it's going to have to require some changes, right? Now, sometimes, make that point in a second. First thing is that the timing of reserve contributions has to be consistent with the timing of the overall assessments. Okay, so if your association collects dues monthly, there needs to be a monthly reserve transfer. Okay, I think it actually has to be made by law within 30 days. If you have quarterly dues, then it can be quarterly. But the point is that you cannot just operate throughout the year without putting money away, hoping that at the end of the year, there's some money left over in the operating account, which you'll then transfer on December 31st and say, look, we funded our reserves this year. It doesn't work that way. It has to be a proactive, ongoing plan. Okay. Now, the last point to make on this slide, and this is very, very often the case, when the historical contribution rate has not been sufficient, right, an association is in bad financial shape, unfortunately, that means fairly often that there has to be an initial special assessment that's effectively a catch-up contribution, right? And that's the way you want to think of it. I've been making this point a lot lately that there's really, in most cases, nothing special about a special assessment. It's just the inevitable result of prior year budgets that were not sufficient, right? It's you're running out of time. You don't have enough money to collect regular reserve contributions before you have to do these projects. So the special assessment is just the catch-up contribution that makes up for all that lost time. Okay, there's a set of principles that come into play when we're designing these funding plans. I'm only going to talk about the last one just in the interest of time. I think the other ones are all pretty self-explanatory, but real quickly, the idea is that when you're funding reserves and you're looking out over the future, you have to make sure that at minimum you're putting enough money away that you never go below zero. Like that is the absolute bedrock, bottom minimum requirement. Cash in, cash out over time. You have to make sure you're not running out of money. Okay. This point about the reserves being distributed amongst all the components, what we mean there is that you're funding everything all the time. You don't take any years off, right? So even though you may have just replaced your roof and the expectation is it's going to last for another 15 or 20 years, you start funding for the next roof replacement right away. That way you're spreading the cost evenly over as many years and as many people, as many owners as possible. The contribution rate should be stable. You can't have a lot of wild swings from one year to the next. A steady increase over time should be expected. But the main point to make here is that this has to be fiscally responsible. So what does that mean? First, it means being realistic with respect to interest and inflation. Okay, on the interest side, it is just not realistic to assume you're going to earn 10% interest each year on your reserve funds. That does not track along with the normal stock market, right? Reserve money just can't be invested in anything very exciting. It's, T-bills, CD accounts, very boring stuff. So that means that if you're going to assume interest earnings, which you can, that should be a fairly low percentage, a fairly low return on those funds. With respect to inflation, got to be realistic there too. What we have found is that through, looking backwards at historical data trends, over a long enough period of time, the average annual inflation rate is very reliably in the 2.5% to 3% range. Okay. Obviously, there's years where it's higher than that or lower than that. This year, the last 2 years really will be an outlier when we look at this in a decade or so. But when you zoom out even further, you look at a 30-year window, accounting for that variability, you're going to come up with about a 3% average inflation rate. That has been historically true for probably the last 100 years or so. But the point is that if you're assuming that the cost of a project 15 years from now is going to be the same as what it cost you today, that's not realistic. That plan will not work. Okay, the second point on the slide here talks about being honest about the situation that you're in. Okay, if the community has historically not done a good job of funding reserves, it's time to address that. Let's get that out in the open. It is just plain financially irresponsible to continue operating that way just to try and maintain some kind of status quo. Okay, it is not the job of the board of directors to make the owners happy. It is not their job to keep the dues low compared to the building or the community down the street. Okay. The owners, speaking about the owners, the reserve funding plan cannot be biased in favor of the people who live there now at the expense of the people who will live there later on, right? We can't just assume that, some future group of owners is going to be perfectly happy to pick up the tab for all these years when we're not funding reserves, okay? And lastly, this all takes place despite what may have happened up to this point. We see this all the time. The prior budgets were not funding reserves. They were waiving or partially funding. The association has effectively had the can kicked to them. That is not an excuse to turn around and kick it on down the road for the next group. Okay. In a perfect world, of course, all associations would have been carefully managed. They would have been guided to a stable financial position, but it's just usually not the case. But I want to make it very clear that does not in any way remove the obligation of the board of directors to act responsibly and to fulfill their fiduciary duty. Okay. Now, look, guys, we understand this. This is a challenge for most communities. If you've been operating for many years on shoestring budgets, waiving reserves, partially funding, there's a good chance you're going to be a financial hole that's going to be difficult to climb out of. But it's important to be realistic about that, right? The owners in the community deserve to make an informed decision, right? They need to understand that, the status quo is not going to hold. It's not going to work out. There is no such thing as getting away with it, right? You will have to pay this money one way or the other, either in the form of reserve contributions or bank loans or special assessments, or in the worst case scenario, in the form of dropping property value, right? If you go to sell your home and the community is kind of dilapidated and the balance sheet is a mess, that means something to a potential buyer. They're not going to be willing to pay as much for that home anymore. So all right, that concludes that kind of second part. Now I'm going to do maybe 5-10 minute overview on Senate Bill 4D. So before we dig into this, again, I'm not an attorney. What I'm giving you is my opinion as a professional in the reserve study space. There may be conflicting opinions that you may hear from others, but I think that most of what I'm going to talk about is generally a widely held opinion about this bill. For those that kind of don't know too much about it, what I'm going to do is talk about maybe 3 or 4 major ideas that got passed here. To back up for a second, this Senate Bill 4D was passed at the end of May of this year. It was actually during a special session of the legislature that was initially called to talk about property insurance. So if you've been reading the news, there's a special session, I think, starting today that's going to talk about property insurance again. But this came about at the end of May. And I don't think there's any, surprise here. This is very, very much the result of the Champlain Tower South collapse, the tragedy that killed 98 people summer of last year. So, I think the legislators were tasked with coming up with a formal response to that and trying to prevent that from happening again. And I'm glad that's not my job. That is a very, very complicated scenario. But just to show you or give you the overview of what we have here, the Senate Bill 4D has a bunch of good things in it. I think the intent of this bill is very strong, and it's going to make life better ultimately for condo and co-op owners in the state of Florida. But here's some of the things it requires. First of all, more transparency, more availability of documents, right? Things like building inspections, balance sheets, just all the communication, the documents that are provided to associations. I have not heard anybody criticize that transparency requirement, that these things be available to potential buyers, to to owners who request them. Board members should never be operating in the dark. I think everything that takes place in association should be public record. I have not heard anybody really criticize that. The second part, the second major idea here is milestone inspections. Okay, so just to be clear, this bill only applies to condos and co-ops 3 stories or higher, right? So HOAs are excluded from this. There's some debate about condos that are 1 or 2 story, whether they are subject to certain things, but the milestone inspection part of it only applies to buildings 3 stories or higher. So what that means is if your property is within 3 miles of the coastline, your first milestone inspection must take place after the building is 25 years old, and then every 10 years after that. If you're more than 3 miles from the coast, the first inspection has to take place at year 30, and then every 10 years after that. Now, what does this mean? A milestone inspection to me is very similar. I think it's basically an expansion of the 40-year certification requirement that we've had in Dade and Broward County for a long time. It requires an architect or an engineer to come out and inspect the building, basically give it like a overall physical checkup. As buildings age, they accumulate more problems, more deterioration. And these milestone inspections are there to capture that, to see what's needing to be done, what needs to be fixed, and to make recommendations going forward. So again, have not heard really any criticism of that concept. I think there's some issues with just the volume of work there, which we'll talk about in a moment, but milestone inspections generally, I think, are a good thing as buildings age. By the way, for the same reason that as people age, we need to go to the doctor more frequently and maybe see some specialists for specific things, right? A building that's 5 years old is maybe like a 10-year-old kid that usually there's not a whole lot going wrong there. But as you age, those problems become more frequent and more serious. Structural integrity reserve studies, that is a completely new concept. I have another slide to follow on this one, but this is the part that I think the legislation got maybe not wrong is maybe not the right word, but there's a lot of room for improvement there about what they're trying to do. The last part about mandatory reserve funding, I think, is great. For those of you who don't know, I've mentioned it a few times that associations in Florida have been allowed to waive reserve funding or to partially fund their reserves for a long, long time. Florida is the only state in the country where that has been the case, right? Everywhere else in 49 other states, and we have clients in all 50 states, so I can say this with confidence, you can't waive your reserves, right? And I guess specifically what I mean there is that the membership of an association does not have that ability to vote to waive reserve funding, right? Everywhere else, the board sets the budget and that's it. There is no opportunity for a group of owners to weigh in and say, we want veto power over this line item in the budget. That doesn't happen anywhere else. And curiously, it doesn't happen for anything else in the budget, right? The owners cannot get together and waive their management fee. They cannot waive their insurance bill. They can't waive their janitorial service, right? But for whatever reason, they've been given the option to waive reserve funding, which is never, ever a good idea. And that's largely why we're in this position that we're in. So let me zoom in a little bit on this structural integrity reserve study concern. Well, first of all, there is no such thing. Okay, reserve studies, as I've been describing them, have been around for decades. There's industry standards. There's very qualified people who've been doing these for a long time. It's very well understood what a reserve study is and is not. Adding in the terms structural integrity, I think, is kind of a Frankenstein approach of taking some structural types of things that you would probably better deal with in a milestone inspection and trying to fund for those in advance through reserves. It just doesn't make sense. There's not really a well-defined way of doing this. I mean, this bill passed at the end of May. Our company has yet to provide a structural integrity study. I don't know really of any other providers that have adapted to this either. I think everybody's generally waiting to see what happens this coming spring when the legislators get back together. Seems that consensus opinion is that a cleanup bill, or what they call a glitch bill, will be forthcoming that will change some of the terms here, change some of the requirements. And I think that's a good thing. As I mentioned, I think these are redundant. If you're going to have a specialist, a qualified engineer come out and inspect your building as it ages, I think having a qualified engineer or somebody also doing a structural integrity reserve study is redundant. That's adding costs to associations. It's going to be largely coming up with some of the same conclusions, I think. I don't know why you have to do that twice over. The frequency of these inspections, of these studies, is not enough. They're saying this would have to be done every 10 years. As we talked about earlier, a lot can happen, especially in Florida, and every 10 years is just not enough. A lot of ink has been spilled about the scope of work here. So they put together a checklist of about 9 things that would need to be included in a structural integrity reserve study and funded for by that association. And so some of the things they put in there, for example, are the foundation of the building, just the categorically the load-bearing walls and primary structural members, plumbing, electrical, fire protection, windows. These are not structural things, right? They need to be addressed. They need to be cared for as the building ages. But if the intention here is to make sure that buildings are structurally sound, you don't really think of these things as structural concerns. And meanwhile, they left off a bunch of other things like elevators that I think are very, very meaningful and impactful that you would always put in a reserve study, but were not included here. So there's a lot of concern about the scope of work. The sheer volume of how this would all transpire is pretty mind-boggling. When you add together all the condos and co-ops that would be subject to this new bill, you're talking about close to somewhere between 25 and 30,000 properties. And the requirement is that all of them have a structural integrity reserve study done by the end of 2024. As one engineer put it to me, in her opinion, there's not enough manpower in the state of Florida, and maybe not in the entire country, to have that many buildings inspected in that short amount of time. So I just think it's impossible to actually implement this. The last part talks about who's actually doing this work. A reserve study has never required that a person have a state license as an engineer or an architect. You know, as I said, we have reserve specialist credentials. There's a professional reserve analyst credential. These are industry standard credentials for people who do reserve studies. It's not the same as an engineer or any other type of professional, and requiring that the visual inspection be done by a licensed person. Again, it poses extra cost, and it kind of implies an expertise that's just not there. You know, I deal with engineers all the time, and I think they would not take offense in us saying that reserve studies are not their bread and butter. It's not what they do all day long like we do. So just some of the problems and concerns that we've seen there. So for those that are wondering what should we do? Well, here's some suggestions. Of the requirements in this bill, I think that the milestone inspection requirement is here to stay. I think that that's a good thing. I think if you're an older property, if you meet that 25-year or 30-year age requirement, it's time to get in line, time to talk with an engineering firm about how to do that milestone inspection. I think that's a good idea. I would consider that you, or recommend you consider a traditional reserve study. And so not necessarily a structural integrity one, but you know, bring in a company that knows what they're doing, that can help you with long-term capital and budget planning like we do. And when I say we, not just our company, but tons and tons of great providers out there in the space who know what they're doing when it comes to reserve studies. And I think maybe most importantly, it's time to have some tough conversations. I think every condo and co-op resident in the state needs to understand this is a big deal. The costs of living in your property are very likely to go up. And there's a lot of reasons for that. I think insurance obviously is getting more expensive. The waiving of reserves, the ending of partial reserve funding, that's going to have a big impact on the bottom line for a lot of communities. And it's not a bad thing. Okay, that's going to sting a little bit. And unfortunately, there will be owners in some buildings who find they can't really afford their home anymore, or that it's getting a little more painful. That's not the legislator's concern. Their concern is making sure that associations are viable places to live for people. Maybe not for all people, but the idea is that we can't have buildings collapsing in the middle of the night through some combination of construction problems, lack of maintenance, lack of reserves. They're trying to do what they can to prevent that from ever happening again. So this is a developing story. Like I said, there will be a cleanup bill forthcoming, and we're very interested to see what that looks like. But I think pretty much everything on this slide is true, in particular that last part there. So we're just over the top of the hour. I'm going to go ahead and turn my camera back on, and then I don't know, Jeff, if we want to start running through Q&A, but let me sip some coffee and then we'll dive right into that. Okay, definition of fully funded for SIRS. Any possibility that the fully funded requirement date will be extended since funds being used now for hurricane recovery? Yeah, it's a good question. I think our company got together with a bunch of other reserve study providers and gave some formal recommendations to the Florida Bar and to the legislators about what we think should change. And one of the big suggestions we had was extending the timeline. I think 2 years from now is much too short for a lot of associations to turn the ship around and get their owners familiar with the kind of the new the new world order, so to speak, especially in light of, a lot of communities sustained a ton of damage in the last year. So I'm hoping that date will be extended. The definition of fully funded, I don't think is very different from what we have been talking about. So let's see, do we have an engineer on staff to do the structural integrity reserve study? So on my staff, I have I think it's 9 people with engineering degrees, but none of them are PEs. So if you go with the letter of the law here, you would have to be a licensed professional engineer or architect to do the visual inspection portion of the reserve study, assuming that requirement stays there. What we have done in a bunch of cases now is kind of talked about partnering up with engineering firms. We have a lot of clients that have good relationships with engineers who are familiar with their properties, who can do some portion of the visual inspection, and we'd come in and do everything else. And we kind of join forces to collaborate. I think we'll probably see more of that happening in the next few months, but nobody has really totally adapted their practice to doing that just yet.
Hey, Will, before you get to the next one, just want to mention, since Q&A is not required for everybody to get their credits, some may want to hop off.
Mm,
Hopefully
true.
not. Will's got some good stuff here, so don't leave. But just in case you must go, in the chat, we just placed the link for the evaluation. So go ahead and click on that link and you'll get a window that pops up that will not take you away from this. So don't worry about that. And you go ahead and fill out your evaluation as well. Let's take a look on that evaluation page. You'll see all of our online partners as well. So back to you, Mary Ellen. Will.
Awesome. Thank you. And I'll try to run through these quick. So do all expenses paid out of reserves have to be over $10,000? No, you can use reserve money for things less than that. And I think as I made the point, I think you should, especially in smaller associations. Correct procedure to transfer funds remaining from a special assessment to reserves. That's kind of getting out of my wheelhouse. I think that's a great question for a CPA or a bookkeeper. I can't imagine that's a very complicated thing. Maybe just has to be formally noticed or approved maybe during a meeting, but yeah, that should be pretty simple. Okay, with insurance rates going through the roof, yeah, pardon the pun there, is it acceptable to have a reserve line item for future increase of the insurance rate and or the deductible amount? So for the deductible, I would say no, that better off to have an emergency fund or line of credit for paying that deductible. But yeah, absolutely should consider that cost may increase over time. You know, as your coverage amount increases, your deductible is typically a percentage of the coverage amount. So pay attention to that each year, work with your carrier, with your insurance agent to find out what those might be in the future. Again, I would say reserves not the best way to do that, but definitely assume that's going to go up. Should the association have a reserve for a reserve study every 3 years? You can, but usually the cost of a reserve study is, you know, for most associations, it's pretty easy to put in the operating budget. You can, but I would say most of them do that as an operating expense, similar to hiring an accounting firm to do an audit, working with a law firm for a legal question. The cost of a reserve study is usually in the thousands of dollars, not tens of thousands of dollars. Okay, does SB 4D cover HOAs? No, it does not. That is just condos and co-ops. See, I manage a gated townhome community that was set up as an HOA. Would you recommend that we start reserving for roads, gates, walls, fence, streetlights? We are going on 5 years starting next year. Yeah, absolutely. If the association is responsible for those things, those all have finite life expectancies. They will all cost you money eventually. The earlier you can start funding reserves for those, the better off. It just spreads the cost of ownership over a longer period of time. So yeah, never wait to start funding. It's kind of like, I use this example all the time. I have a 5-year-old son, and my wife and I are trying to save money for his college fund one day. And we started when he was a baby, and I'm glad we did, because if we waited until he was 13 or 14 years old, starting high school, you're just shrinking the window of time available to get that money together. So as an association, start from day one. If you can spread out your reserve contributions, you'll be much better off. What date is the mandatory full reserves funding effective? So Senate Bill 4D, that all takes place, and I think there's a similar question following this one, December 31st, 2024. From that point forward, that's when Senate Bill 4D takes effect, unless it gets delayed or deferred, which I think is not a bad idea. Let's see, do you think the law will be amended directing property managers will be responsible for future budget planning? Sorry, I'm just reading these questions on the fly here, versus a board trying to guess through this planning and understanding. I think ultimately the board is always responsible. They are the officers of the corporation. Property managers are there to help and assist and to help govern. I should say not to help govern, to help manage the community, but the board should be the ones who understand this stuff as much as anybody else.
And remember, no matter who's helping planning the budget, whether it's the board, the CAMs, or a combination of the both, a budget is your best guess. I mean, there's no exact science to this. You just do the best you can and hope for the best, and explain that to your community. Never be concerned about over communicating, because things can change. Correct? Absolutely.
Yeah, knowledge is power. Yeah, inform everybody, help them make informed decisions, right? For a long time, that's been our selling point to communities is, look, if you're going to waive your reserve funds, as people have been allowed to do, at least make an informed choice about that. You have to understand this work will still take place. You want to have money set aside for it, because if you don't, you're going to have special assessments. It's a guarantee. And so that's a message we've been hammering for quite a long time.
You have time for a few more. And thanks for reading them, by the way. I'm coughing uncontrollably. I'm still getting over something. So I appreciate you reading those questions. I know you're seeing it the first time.
It gives me a chance to think about it while I'm reading it for a second. So yeah, apologies if I'm not reading anybody's intent correctly, but let's do a few more. Our condo association has 2- and 4-story buildings. Will our budgeting include mandatory reserves for the 2-story buildings as well as the 4-story? It's a great question. That's one of the things that's not clear. So obviously there's associations out there that have buildings of different height. Initially, what the law says is you would have to have a structural integrity reserve study done for each building 3 stories or up. But we've criticized that, saying, well, a building is a building. An association can be comprised of many buildings of different heights. It's all one budget. So the owners who live in a 2-story building are still paying for costs for the people who live in a 4-story. So yeah, it's one of the things that I think was not terribly clear at this point. Can you speak more about the demand for accredited inspectors and reserves professionals in balance with the looming deadlines and demands? Any advice? Boy, that's a tough one. It's a fairly small industry. There's, if we added together all of the reserve study, companies in Florida, you're talking about a few dozen people. And there are, as we said, tens of thousands of buildings that need to be done here. So, we're trying our best to hire and train as quickly as we can. I would say, get on a list now. We have a queue of work we're already starting to plan ahead for next year. We're trying to buy everybody more time. But yeah, it is a supply and demand issue right now. There's not a whole lot of experts in the reserve study field, and we're doing our best to work with as many communities as we can, as responsibly as we can. Okay, I think we talked about the dates. Is it HOA required to fund reserves if membership has not voted to defer them? That depends on whether or not you have statutory or non-statutory reserves. So if you have statutory reserves, then yes, I would say that the proposed budget, including full funding of reserves, that's the default that always goes into effect unless the members vote to do less than that. So let's see, I think we've got maybe one more. Does the Senate bill address when the reserve funds have to start being funded separate from the date the study is to be completed? Yes, I believe that it's going to be that December 31st, 2024. That's the date, so it's after that, I guess, is when the reserves would have to start being funded, but you should start right now. And last one, I like this question. What do you do with these board members that are obstructionistic? I'm going to just say,
give you a tough time.
being difficult about reserves. Write down on a piece of paper, what are the options, right? Well, yeah, I mean, if you've got board members, first of all, who are not upholding their fiduciary duty, they are probably in breach of what they call the business judgment rule. They are not held, or excuse me, not protected by D&O coverage in that case. So you need to point out to them, look, if you are acting badly as a board member, that can really land you in some pretty hot water. And maybe they decide, maybe I don't want to be on the board after all. But the big picture is that this stuff's not going away. Reserves are vitally important for associations. And if the board members are not doing a good job of leading the community, I think it's time for somebody else to step up there. So
yeah, well, couldn't agree more. And I think the best way to do it is just communicate exactly, be transparent. Yeah. And then when things don't go the way you hope they go, people will begin to see that the board is truly trying to do the right thing, and that if you have a few that are not agreeing, if you I hate to use the word over communicate, because sometimes you can over communicate, but as long as you're transparent, be upfront about everything, the projects that need to be done, the actual cost, your comparisons, the whole 9 yards, that's how the board can best protect themselves from, I guess, for lack of a better term, from renegade board members. So just put it all out there, and the rest should take care of itself during the next election cycle.
We'll find out.
Right.
So yeah, I think that's it for my time. Thank you guys so much for the opportunity. Thanks everybody for joining us today. It's really a pleasure. Thank you.